Welcome to Finder Australia, where we bring you the latest news, information and guides on the wild world of cryptocurrency. Some of you may already know this, but the Australian Tax Office has been flexing their muscles towards crypto owners who might have forgotten about their tax obligations. Crypto is a popular investment, especially with the younger population who may not have had a lot of exposure to how tax works in the first place. Combine that with the fact that crypto is still very novel in terms of legislation, it's no surprise that you've got yourself a recipe for confusion. But fear not, we are here to make it all a lot clearer, and we're here to rescue you from the clutches of the ATO to ensure that you don't spend the rest of your life in jail because you put 10 cents into Dogecoin 5 years ago. But before we jump in, click like, subscribe and hit that bell for more videos to help you become a crypto connoisseur. Alright Aussies, let's teach you all about paying your taxes on cryptocurrency. Let's say that you were to buy a house for 100 grand. As if, and then after renovating and waiting 10 years, you sell it for 500 grand. You might think, you beauty, I get to keep $400,000. Unfortunately, this isn't the case. On top of various fees, sellers pay what's called a capital gains tax. This tax applies to the sale or trade of any sort of investment that results in a capital gain. This applies to assets like stocks, dividends, bonds, real estate, and even obscure collector's items like Beanie Kids. That's right, you have to pay taxes on that ridiculous leprechaun stuffed Beanie Baby toy that you sold and made a profit on. So how does this all work with cryptocurrency? Crypto being, well, crypto has been flirting on the edges of legislation, and government bodies have been looking at issues and answering questions like, what is defined as a cryptocurrency? Is it different to trading with cash? How should we deal with the anonymity of transactions if criminals or tax avoiders are exploiting this? To combat this, the ATO has made it a focus to more strictly define the parameters of cryptocurrency as a taxable asset. Despite this, the waters are still a bit murky. And that's why, if you have a lot of capital tied up in crypto, you really must consult a tax professional. And despite the concept of taxes giving us a collective eye roll at times, you know, tax is critical because without it, there's no healthcare, no public services, and no welfare. So I've explained what capital gains tax is and that the ATO is starting to crack down on crypto, but we still have no idea what they can actually tax you on. So time to fix that. The basis on how a capital gains tax is applied to crypto transactions is relative to the Australian dollar. That basically means that anytime you sell, spend, or trade a crypto asset, even if currency isn't involved, means you'll pay tax if you make a profit in terms of Australian dollars. If you buy or otherwise obtain one Bitcoin and it's worth $3,000, sell and spend it all when it's worth $10,000, you'd likely incur a $7,000 tax obligation the minute you spend it. And that's a pretty straightforward explanation of how cryptocurrency is taxable, but the reality is more complex, so let's get stuck into it. If you're operating as a business or a professional, any gains or losses are subject to income tax. You know, it's like the one that comes out of your pay every fortnight. But this is why cryptocurrency is such a difficult thing to legislate. The ATO has said if you operate in a business-like manner, then you'll be taxed accordingly. But what really defines business-like? If we wear a suit and tie, does that automatically mean we have to pay an income tax? At what point does having a small mining setup become a professional enterprise? Again, this stresses the need for consultation with an expert accountant before you dive in. Typically, you can be taxed as a business if you mine cryptocurrency commercially, you have rewards from staking, providing liquidity, or if you trade assets as a business. You run a crypto-based business, for example, if you own CoinSpot or trade it on behalf of clients, or transactions for a business made in cryptocurrency. When you're being taxed on a personal level, it is a lot simpler. Personal crypto assets are viewed under the lens of capital gains, which means the tax rate is usually a lot more favorable. Some examples of personal use include investing in cryptocurrency on an exchange, like CoinSpot or Binance, or on behalf of yourself. Mining crypto as long as you do it as a hobby. Trading cryptocurrency on a relatively small scale. Although we know the instances that might incur a taxation, we still don't know exactly how the ATO actually views cryptocurrency. The tax office doesn't view it as a currency. It's currently classified as a property for tax purposes. Any digital coin or asset that operates like Bitcoin is determined to be a cryptocurrency. Again, this isn't the most crystal clear definition, but it's intended as a catch-all for what is a rapidly evolving market. In contrast to their broad definition of the currency, the ATO has some pretty clear guidelines when it comes to reaping what they've owned. Capital gains taxes will apply when you sell or gift a cryptocurrency, trade or exchange cryptocurrency, including crypto to crypto trades, convert cryptocurrency to a fiat currency like the Australian dollar, or use cryptocurrency to purchase goods or services. What this means is that whenever you dispose of your cryptocurrency, and no, they don't mean into a bin, you need to consider whether you've made a profit. There's no need to be so glum about it though, there are exceptions. For example, the ATO will offer a CGT discount on 50% on investments that are held for over a year. Also, you haven't actually gained or lost any money until you sell or transact the cryptocurrency. Let's say you have Bitcoin sitting in a wallet. You purchased it at $20,000. Now, a few years later, it's worth $50,000. As long as it's sitting in your wallet, you don't owe the ATO a cent. Until, of course, you dispose of it. There are also situations where you won't have to pay tax at all, even if you come up with a tasty profit. This is another difficult one to define, but essentially it depends on whether the crypto is determined as being for personal use. This comes into play if the crypto is used to purchase personal goods and services like shopping, retail, booking flights and accommodation for vacations and so on. You can also be eligible for the exemption if your capital gains are less than $10,000, though they still have to be for personal use. If you put your money into a crypto coin as an investment or in any way make a profit, it can no longer be classed as for personal use and will be taxed accordingly. Generally speaking, the longer your money is tied up in a crypto asset, the less likely claiming that it's for personal use will fly with the ATO. So we've got an example. Let's say Traveller is offering a discount on customers who book a hotel using cryptocurrency. We purchase a coin through an exchange, and in the time between then and buying a hotel on Traveller, the coin rises in value. We don't need to pay a capital gains tax on the hotel booking, even though there's a discount for using crypto assets. Because the market rose, there is still a little bit left over in our exchange wallet. If we were to leave the leftover funds in the exchange for another year before selling it at a profit, we would have to pay tax on that sale. Hopefully, that's started to help explain the difference between personal use assets and investments. It's still worth quickly touching on capital losses though. As with any other asset, you can also realize capital losses. This basically works inversely to capital gains. If you lose money on a transaction, you can use that loss to offset any tax you owe on positive trades. This not only includes market crashes, but also if your crypto was stolen. Or, God forbid, you lost your private key and can't access your wallet. Hopefully it never comes to that, but at least there's a slight, oh so slight, ray of sunshine. Depending on the tax rate, some accountants can maneuver intentional capital losses to get clients into lower brackets, which will actually end up saving them a bit of money. But as I said before, please don't try anything like this without professional assistance. You might just end up with a knock at your door and a group of stern-looking individuals berating you. Yep, that's something you'd want to avoid at all costs. At this point, you may have noticed we haven't mentioned staking much in this video. That's because things like staking, yield farming, and receiving airdrop tokens have their own clause when it comes to tax regulations. Simply put, you don't have to worry about capital gains tax on tokens earned from staking. But before you pop in the champagne and celebrating, it's not because you don't have to pay tax, it's because they're viewed as income. Any additional rewards earned through means such as liquidity, provision, and staking are eventually added on top of your usual income and taxed as such. So now you might be thinking, ugh, we've covered pretty much everything, right? Not so fast. What about if there's a chain split? A chain split is the instance where a blockchain diverges into two separate cryptocurrency. The most common example of this is in the storied history of crypto when Bitcoin broke up with Bitcoin Cash. When these forks occur, asset holders are usually deposited the new coins at a ratio of 1:1. Though the initial receipt doesn't carry any tax obligations, if you hold onto the new asset as an investment, you're gonna have to cough up some of that to the ATO. For example, if you acquired 10 Bitcoin Cash during the 2017 Bitcoin split and then sold those coins today at around $1,000, you'd have to pay capital gains on $10,000. So we've covered pretty much every permutation of cryptocurrency in the way it can be taxed. But this is only the beginning, and it's really important you do some further research on the ATO site to gain a well-rounded picture of tax implications. Given the potential complexity of getting your tax right with crypto, it's essential you keep detailed records of all your transactions. Dates, values in Australian dollars, wallet keys and receipts are all vital to being able to lodge a claim at tax time without worrying that you've missed something. If we had to give you one piece of advice, it would be to consult a professional. Yep, I know that's shocking and I've only said it about 10 times, but really, for those that have invested a lot in crypto, it's a really good idea. Not only will they help you calculate your capital gains and potentially minimize your tax, they'll also keep you out of jail by ensuring that you accurately and thoroughly disclose your crypto transactions. Remember, you're not Tony Soprano, and it's best to let the ATO know your financial movements because they've made a point of targeting crypto users. Come tax time, you don't want to have to worry about the ATO sending you letters about that 25 Dogecoin you sold without telling them. That's it for today. Hopefully this video has helped push you in the right direction when it comes to understanding how Australian tax works with your cryptocurrency assets. Now, if this video wasn't enough, you can find our full article on cryptocurrency tax in Australia in the description below. It provides a much more in-depth view on the tax obligations for businesses and investors. So make sure you check it out. And if you have more questions, please leave a comment below. Happy filing!